So, good morning, everybody. I hope everybody is well. Happy New Year. It's coming soon, right? Unless you look at these after, then it's passed already, but I hope everyone has a good New Year. Okay, so picking up here on slide 44, where I kind of left off, is you can look at types of capital. For capital structure, is how are you breaking your money you got coming in into debt and equity. And here's the this is a simplified balance sheet. And you can clearly see here's your total capital, which is the sum of your debt, your long-term debt now, not your current short-term, and your equity, right? Bonds and stocks. Bonds and stocks, if you issued any, either one. Okay? So that's what they're basically saying. And they say right here, two components, right? All right. So, because you're able to write off the interest you pay to this is very important, the bondholders, you can write that off on your taxes. The cost of debt is always lower than the cost of other forms of financing because you can write it off. And also, people who loan you money are taking the least risk because basically, whoever gets paid first, which is always the bondholders, they take the least risk. So if the company goes under, you should always know that the bondholders are going to get paid first. And the last paid are the common stockholders. So they take the most risk and they demand a higher return, which is why companies like issuing debt. And they say it right here, the tax deductibility of interest payments also lowers the debt cost to the firm substantially. So, that's... All right, so debt capital, eventually, right, if you loan a company money, you got to get your premium back when the bond matures, of course, and the company's got to, you got to be repaid, right? And equity capital, theoretically, will be invested in the company forever, right? There's no maturity date. So when it comes to stock, there's two types, right? Preferred and common stockholders. And as the name will tell you, preferred stockholders get paid before common stockholders, right? Now, you'll notice the word here, retained earnings. Companies, if you remember from 330, companies issue statements of retained earnings. And this is money that should be paid in dividends to the shareholders, but it's not. They're keeping it. Like Google, right, doesn't pay dividends. A lot of companies like high tech don't pay dividends. They want to use the money for research and to grow the company. So they'll retain the earnings. All right, so common stock is the most expensive form of equity, followed by retained earnings. So there's equations for all these theoretical equations, of course. All right, so if you remember from 330, there was a ratio. Remember we did a lot of ratios in 330, if you want to review that. Right, direct measure of the degree of indebtedness is the debt ratio. And from 330, you can review, I think the slides from the earlier chapters are up because I used the same book, right? Gitman for on 330. Total liabilities are divided by total assets, right? Total liabilities include the current assets, right, too, right? So this is an important statement here. The higher this ratio is, the greater the relative amount of debt or leverage, which we previously talked about in the firm's capital structure. So you should go over this. So basically, the level of debt, right, financial leverage that is acceptable for one industry or business can be highly risky in another, right? So debt's, you got to be careful, and then the analysts will lower your credit rating, and you'll have to pay more if you have too much debt. It's kind of like when you have a house and you're in debt up to your, you're in hock. You're going to basically pay a higher interest rate on loans. All right, so here's different debt ratios for different industries. This is a nice little table, except it's quite old. It's 7 years old, but different industries have, different companies have different debt ratios. And you can do some research and figure out why that is. But you'll notice here, the healthcare has got a very high healthcare and social assistance has a very high debt ratio. All right, so as I was mentioning, here is the personal finance example of people with debt, and this day, whatever is applicable to a business is applicable to you personally, because you personally are a business with one person, and you should treat yourself like that, you know. So as we roll along, some of this is just a historical stuff here. You can read this on your own. All right, so we're going to get a little theory on what's called an optimal capital structure range. So you'll notice it says here you can't. They don't have a precise methodology for determining a firm's optimal capital structure, but some old financial theory will kind of tell you what's the ratio you should have between debt and equity, right? So Modigliani and Miller, known as the M&M boys, demonstrated algebraically that if you have what's called perfect markets, which means you have information coming in, and this was discussed in your book, What a Perfect Market Is, but it means all the available information is there for you. And they claim that whatever capital structure you choose does not affect the company's value. So there's been a lot of stuff that's gone back and forth between that. Okay, so there's they basically have this theoretical optimal capital structure, based on of debt financing. Because like I said, a lot of companies like to do debt financing. All right, and the reason companies like debt financing, as I previously mentioned, is there's a tax benefit. You can write off the interest you're paying to the bondholders. And there's a nice little equation down here. Here's your cost before debt, and here's your cost after. Before taxes, and here's your cost after taxes. And this equation is very similar to what you use when you write off your mortgage, right? Your mortgage, you can write off your interest payments. So really, your mortgage is lower than your debt payments. Than the interest rate that they're charging you, because you're writing off the interest. So that effectively lowers your interest rate on your mortgage. All right, so here's an example from a Cook Company, and theoretical chances of that their sales are going to go from like 400,000 to 600,000. And then up to, and then 80, 100,000. And so they have a whole capital structure example here. So here's the sales revenue with the probabilities, if you remember, all right? And the big question, of course, is how did they determine these probabilities, right? So here's the revenue, here's the fixed costs that don't change, and here's the variable costs that will go up depending on your sales revenue. And here's your EBIT after you do the simple math, 800 minus 600, and 600 minus 500, right? So here you're actually breaking even, right? All right, so what I think I'll do is I'll go into this in a little more detail. So I'll kind of stop at this slide now. We're about 9 minutes in, and I don't want to make these videos, as I always say, files too large. So I'll kind of cut it off here. All right, I'll talk to you later. This is part 3.